Hello, everyone. Thank you for being with us in this new chapter of the Outliers powered by Freezon Capital. Today, we have a very exciting guest, Renato Granmont, one of the leaders of the financial industry in Latin America. We're humbled by this interview. I would love for you just to share a bit about who you are, what you're doing right now.
Great. Well, thank you very much, Pedro. It's a pleasure to be here with you. My name is Renato Granmont. I'm half Brazilian, half French-Canadian. I've been in the US since 1994. I'm married to a Mexican, so I speak Spanish with a Mexican accent. I started my career in Philadelphia, working for Wharton Econometrics as an economist, and then from there came to work in New York City as an equity strategist for Merrill Lynch on the institutional side. And then from there, I work as a head of equity strategy for Deutsche Bank. I ended up founding and heading a group dedicated to corporate governance. So this was something based within the investment strategy universe, where we analyze companies not only on a financial basis, but also on a corporate governance basis. We were the pioneers on this. And because of the work we did, we ended up participating in the reform of capital markets and listing standards in countries like Brazil, Argentina, and Mexico. Out of a work that started in Latin America, analyzing companies on a corporate governance and financial basis, we expanded it to emerging markets. And then after Enron and WorldCom blew up in the US, senior management of Deutsche Bank asked me to make this a global group, and we analyzed over 2,000 listed companies. Then from there, I worked for a hedge fund, which was part of Paloma Partners, and then from there, I worked at Citibank as chief investment officer for the private bank in Latin America, and then for the wealth management group in Latin America. And also at one point, I was the global interim chief investment officer for the private bank. I've traveled extensively throughout Latin America, visiting companies, as well as families, as well as regulators throughout my career.
It's very impressive, but you left out something that I think it's super relevant, because you're part of this fantastic angel network of Harvard Business School, aren't you?
Yes. So Harvard Business School alumni has an angel investor club in New York, and I'm part of the Harvard Business School alumni angel investor club. In fact, they asked me to be the fintech co-lead for the club. We analyze companies, all sorts of companies in all segments of industry that come to pitch to us. So it is really interesting. I've learned a lot, and I'm able to participate also in some companies and helping some of those entrepreneurs, sometimes giving them feedback.
That brings you directly to the topic that I wanted to discuss today, which is early stage investing in emerging economies. Some of the things that we've been seeing as Freezon Capital is that whenever we talk to people that are part of a family office, that are creating a family office, people that already are kind of financial savvy already, whenever we talk to them about certain things specifically like deep tech or Latin America, it seems that they don't have those parameters in mind. What we've seen in data published by entities like PitchBook, for example, Crunchbase, TechCrunch, we see a trend very interesting of these lines that go up in graphs and everyone gets excited. But then we talk to people and they probably haven't read those papers, or for some reason they're not aware of it. My first question would be, how do you see the market of the different vehicles that people have to invest in? I mean, what would be your recommendation?
There's something that I've left out. Over the past few years, I've been advising families. So this is the kind of thing that we looked at all the time, either companies or funds that want to pitch to ultra high net worth families, and also the desire by some families to invest in investments that are not only liquid investments, that are probably not available to everyone, and they have the opportunity to invest it either via private equity or venture capital. I just want to put Latin America in context for some of our viewers. Latin America today has a population of about 665 million people. And it is, some of the countries in Latin America are some of the largest countries in the world. It is a region that is very tied to the US. It is a region that exports a lot of goods and services to the US and to some of the developed countries in Europe. And also it is very linked to Asia through some of the commodity exports. Yet today, when you look at a global equity portfolio, Latin America is probably less than 2%. And then when you drill down into that, Brazil is probably 60% of that. And the rest is the rest of Latin America. There is tremendous opportunity. You have top-ranked universities in Brazil, in Mexico, in Argentina, in Chile, in other countries in Latin America. You have a lot of talent being created, a lot of wealth being created, even though traditionally Latin America has had a very concentrated wealth situation. But recently, over the past, I would say 10, 20 years, we have seen new companies come into the market. For instance, specifically what we're trying to do with Frisson, I think, is to look at this segment of the market that is somewhat untapped, where there is a dearth of capital. There is not enough capital that goes into Latin America, yet there are tremendous entrepreneurs with great ideas. And if we can take a look at those ideas and help them expand these companies, I think there's a tremendous opportunity there, not only in terms of population for consumption, but also for intellectual minds. I think when you combine the entire thing, it is a sector that is not very well looked at. There is not a lot of capital going there. Yet on the supply of ideas and the generation of businesses and ideas, there's a lot going on.
One of the big questions that I would have as an investor would be, where's the best place to put my money? From my understanding, if I were to invest or leave my money in a checkbook, I would basically make nothing, right? I buy government debt from Mexico. I would be getting probably between 6 to 8% a year. My next option probably might be just buying an apartment and renting it. That would give me probably about 9-10% depending on the region. Again, if I'm just a common Joe, I would try to purchase an apartment in a building that's being constructed, and that maybe might get me like a 15% or something like that. And then if I'm a bit more sophisticated, I go to the trading market and I buy this typical fund bags that are offered by any bank branch in the world. But then there's these other categories like venture capital. Why would I take that risk? How exciting is that? What do I need to jump into that? What's your first view on this thing about asset classes?
It's very important for investors to understand asset classes. The way I look at it and the way investors should look at it, there are primarily two groups, and then there are segments within these two groups. There are liquid and illiquid investments. So within the liquid investments, you find cash, fixed income securities, equities, and you can even say derivatives. So these are securities that you can invest, and you can, if you need cash, you can liquidate the position and have your money in 1 or 2 days in general. And then there are illiquid investments, and those illiquid investments would include hedge funds, private equity, venture capital, and real estate investments. The way I look at a family's portfolio, the first thing you would do is separate between the liquid and the illiquid investments. The liquid investments tend to be the majority of a family's portfolio. Some families will want 100% of their investments in liquid investments. So the first separation in asset classes tends to be between liquids and illiquids. And then within each, we look at whether someone has a liquidity need. If you have need of liquidity within the next 5 to 10 years, it's very unlikely that you're going to be buying real estate or you're going to be buying private equity because those investments tend to be on a 7-year plus investment horizon. Equities, for instance, when we invest for equities, the investment outlook should be 5 years, even though you can liquidate your position tomorrow. So helping the families understand what is the investment horizon, what are their needs for capital in the short, medium, or long term. And sometimes, who this investment is for. Is it an investment for you? Is it an investment for your child? Is it an investment that will be locked in for 10, 15 years without problems? So we need to understand the liquidity needs of a family before building a portfolio. But the first thing, is to separate them. After that is to separate between liquids and illiquids. And then we use a rule that whether illiquids should be anywhere from 0 to 30%, 40% for the most aggressive of the families and the wealthiest as well. Because if you're investing in illiquid assets where the investment horizon is 10, 15 years, you got to make sure you don't need that money in the next 2 to 5 years. Separating, looking at, what are the liquidity needs, separating the portfolio into liquid and illiquids. Illiquids being hedge funds, private equity, and real estate. And within private equity, you have subgroups of private equity. It could be private debt, it could be venture capital. I would say, for an ultra high net worth family, it's not unusual to see in their investment portfolio to have 80% liquid and maybe 20% illiquids. And those 20% illiquids, then you need a strategy for that as well. You cannot put everything into one company or one instrument. Some families, after the financial crisis of 2008, don't want to touch some of the illiquid investments anymore. But one of the things that I'm saying is that there is a lot of interest in illiquids in general from the younger generation. For the very large families, then you start to look into vintages. Because as you know, a private equity investment, for instance, will go by vintages. A fund that is raising capital in today's market environment will be investing over the next few years, may be very different from a fund that is raising capital, let's say after the financial crisis or before the financial crisis. So in terms of vintages, the idea is, again, to have an asset allocation so that you not only dependent upon one vintage, one asset class.
Within those different asset classes, what are the best options to consider in terms of risk, return, time, etc.? We've been looking at some material that has been produced by the guys from Founder Institute, where they basically say VC is the best in class asset for return of investment. Usually when you talk about those kinds of things, investors are looking at people that are raising a fund 2, maybe 3. If it could be 4, even better, because they already have established a track record, they have experience in the market. However, the numbers that Adeo has says that first-time managers have the return of investment in the category of the asset class. So can you share a bit about that?
It is, I think, naive to look at expected returns without looking at risk at the same time. The further down you go in terms of asset classes, the higher the risk. For instance, one of the main risks with private equity, private debt, venture capital, and hedge funds is the survival risk. Many funds will collapse. And what happens is that the data that we end up looking at is the aggregate data of the funds who survived. So there is a survival bias on the data that tends to distort the data and increase the expected return or the past performance of some of those funds, of the asset class in general. And then you have the liquidity issue. If you're earning 5% on a US government treasury bond, where you can have liquidity tomorrow and it can be used as collateral for a loan versus an investment that is illiquid, that you have to wait 10 years to be repaid, that you cannot use as a collateral for a bond, for a loan. We always have to look at risk reward, and not only at reward and not only at risk. Also, it's important to highlight that expected returns fluctuate. 6-month treasury bills are paying close to 5.5%. A year and a half ago, they were paying 0.25%. So there has been a major shift in this asset class, which is the risk-free rate. So if the risk-free rate has a major shift, it is to be expected that all other asset classes will also have a shift in expected returns. So normally cash deposits, earning very little is the super risk averse. Then you have fixed income, and then government treasuries, AAA rated companies, AA rated companies, and then the capital structure, goes into the equity side, which is much riskier than the fixed income. And then we go into the illiquids. And the other thing that you mentioned, it is true. A lot of the new funds tend to have very high returns. And then as the follow-on funds start to come in, the returns tend to decline. The reason why that is the case is that normally the first funds have a much more limited amount of money to invest, and they will be more careful in their investments. The bigger the fund gets, the more investments that they will make that will probably make no sense. There are benefits and pros and cons to it. Very large funds will sometimes have access to deals first, and will have access to deals that others don't have access to. But because of the size of those transactions, if something goes wrong, it's a torpedo that just hit their fund.
If I were thinking about investing, maybe, I don't know, a ticket of 100, 200,000, something like that, and I have two alternatives. A friend of mine is opening a fund, so I can become an LP there, or I can go look out to an agent network and just put the money directly into a company. Can you share a bit about pros and cons and
Sure.
the difference between those two options?
Okay, let's say $100,000 is your life savings. You got to be careful. So you have to understand what percent of the net worth that money is. Having established that, if it is your life savings, I would strongly recommend not to invest in venture capital or private equity, because the risk that something goes wrong is much higher. But, then people have their own risk objectives. There are some people that are very risk averse. And then you have, let's say, the level 5 investor who is very pro risk. So it is a personal choice, first of all, to determine that level of risk. And then depending on that level of risk, that's how you look at how you build a portfolio. For those that are risk lovers, so to say, yes, you can concentrate your position if you want. You can buy one company. The difference between one company and one fund is that, again, you concentrate the risk. If you buy a fund will be invested in a number of companies. So there's always a risk that one or two may not do well, but you hope that some of the others will do better. So again, it's a personal choice, Pedro. It's those that want to concentrate their investments. Yes, you can. There are people that do that. In general, we try to recommend an asset allocation where you have a multitude of assets, so that you're not dependent upon one company or one asset class.
There's a big difference of the relationship with the entrepreneur, the investor, the company, and how things work. Because aside from the money and the risk, if you're an angel investor, you're expected to be almost part of the founding team. You're one of the first advisors. You're going to be getting your hands dirty. That should get you excited. It's not only about just throwing the dollars. It's about attending the meetings. It's about supporting the company. And that wouldn't necessarily be the case, right? If you are an LP of a fund, the responsibility of the follow-on, of the follow-up, of the meetings, of the networks, etc., relies on the fund and not on you as an LP. And I think that really makes a huge difference between those two options of investment.
Yes, absolutely. Yeah, as you said, normally most investors would try to be very close to the company, but that's not always the case. There are, let's say, some angel investors that will invest and let the company ride, so to speak, and see how it goes from there. And it's true, when you invest through a fund, that responsibility lies on the fund. So as an investor in a fund, you are expecting the fund management to be on top of the company, to be guiding the company, to be understanding what are the challenges that the company is facing.
Now, talking about like what some people call a pre-seed investment or seed rounds, what are the things that I have to do as an investor just to make sure that I can de-risk my investment as much as possible? What are the things I'm supposed to look at when I'm trying to invest in at that stage?
So I think in terms of what is really important, I think number one to me when I'm evaluating a company is the people who are behind it, even more so sometimes than with the product or the process that they're trying to create. How many companies have done wrong things to minority investors because of lack of ethics by the controlling shareholders? So I think that is absolutely critical, especially in a new company. I think another very important thing is to understand the legal environment in which you're operating. What are the legal recourses that you have as an investor if something goes wrong? And it could be there that it's your the protection of your investments, but also what is the company trying to do? Are they operating under an environment that has regulations and laws? Are they aware of them? Are they not aware of them? Are they intentionally or unintentionally breaking some of the regulations and laws? So I think that's also very, very important. And then obviously is the product and the process that they are trying to sell, and how they're going to reach the market and monetize on what they are proposing to do.
That kind of brings me back also to what we started discussing about Latin America. One of the things that we found throughout the years is that the Latino entrepreneurs are fantastic. The level of resourcefulness, resilience, ingenuity, it's very different from other parts of the world, which makes them very interesting for an investor. Latinos on a part of the world where we have like 80% of the population. So the problems of the emerging economies are shared by more than half of the planet, which makes it exciting because then they're tackling opportunities that should be larger, right? But on the other hand, also, I got this from a guy in Argentina. We had a conversation about entrepreneurship, and I was very curious why there are so many unicorns in Argentina. And he just basically told me, thing is that we're just resilient by nature. I mean, there's nothing to lose because the country is a mess. So we fear nothing. And I found that super inspiring. And it actually made sense to me now to understand why Latinos are doing such amazing things in startups.
I would add something else. I think there is it's education, an entrepreneurship mindset, and that resilience. So when you combine those three, it is a very powerful mix. But then there's one thing that is missing: capital. And I think that's one of the great things that I think Frisson will do, is be able to bring that capital to those entrepreneurs that have great ideas but don't have access to the capital and to the mentorship to lead the company to where it should go.
I love what you're saying, because that is actually the big opportunity that we're seeing, and that we started analyzing when we created Frisson Capital, because there are probably a bit more than 800,000 researchers in the region. And then on top of that, there have been people going to Ivy Leagues to study graduate and postgraduate courses for the last 20, 30 years to the most important universities in the world. So they have the know-how now, and they're going back to their local universities. And with that knowledge, they're creating the new technology. If you make a comparison between what's being created in Cambridge or Stanford and what's being created in Católica, it's basically the same thing. But the difference is exactly what you're saying. There's no money there. So they have to jump to a G20 country so that they can scale the company. And that is usually very difficult. If you were a family office that is like trying to explore maybe not a big chunk of your portfolio, again, because of the risk, and would you look at the deep tech in Latin America? Would you look at the Web3 in Southeast Asia?
Look, I think there are opportunities globally. When we look at that segment of investors, you have to look at new technologies, right? And where do you look at new technology? Is it biotech in the US and the UK, or is it technology developments going on in Southeast Asia, or is it other things happening around the world? The answer is why not all of them? Again, when I was saying at the beginning that here we have Latin America, a very large region in that is top of the world in some areas. There are challenges in the region, and I think that's why the idea of Friesen of taking some of these companies and making sure that they are started in the region, but they have like a registration in the US, and therefore they have a market that is already outside the region, makes a lot of sense. So for some families and family offices that are looking into what are some of the areas where it can deploy capital, where there is not a lot of competition, where the potential returns could be very high. I think venture capital is definitely one area. And then within venture capital, why not look at areas where there is very little capital going to at the moment? So I think that the whole story makes sense on a top-down level, where you have a large region, large number of universities that are world-renowned, a lot of people doing research, a natural market in the region itself, but you have a potentially even bigger market if some of those companies can have access to capital and come to US and Canada and other developed markets.
I totally agree. And one of the things that we find very exciting at Friesen is especially the trends that we've seen on some of the latest reports on VC investment. Carbon and emissions tech is going up, ag tech is going up, supply chain is going up. Like most of the verticals that we're thinking about in Friesen are more important than ever. We found some startups that are just mind-blowing. We found Argentinians printing 3D organs. We found Mexicans creating sustainable cement, Uruguayans creating AI for pharmaceutical molecules. And I guess that is also, I would say, another important thing to take into account when you're looking for ways to invest. Finding deal flow is always something challenging, right? You need to find the filter, you need to find the projects. You also need to understand the viability and the risk of putting your money into that project specifically. And if you're an angel investor, and if you're not an expert in the technology, you might run the risk that it's going to be exciting when you start thinking about it, but then you have no idea if those guys are going to make it or break it, right? That would be a very intelligent move to de-risk your investment.
Absolutely. So I think what makes sense, for Friesen is one is access to that deal flow. Second is the area where Friesen is acting. So in between angel and those early stage VCs. So that's an area that has very little competition in Latin America now. And like, if you want to get into the action, Friesen is the way to go.
Thank you, Renato. I really, really appreciate the conversation we had today. I had a blast. I hope we can do this again soon. I thank you for your time. And for all you folks hearing your podcast on your commute, we really appreciate your time. Hope you enjoyed it as much as we did. And we'll see you in the next one. Thank you.